Hi there, everyone. Welcome to the final bar. It's Tuesday, May 21st. I'm your host, Dave Keller. I'm the Chief Market Strategist here at Stockcharts.com in, boy, a rainy Redmond, Washington. Thanks for joining us every weekday after the close as we break down the market action using the tools of the technical analyst. We have a fantastic guest today, Julius Kempenaer, a frequent guest on our show and frequent host on Stockcharts TV. He's going to be talking about some disagreements, some inconsistencies with this market. Yay, we're making new all-time highs. Yay, the Dow barely snuck above 40K, but there are some issues, and we'll go through some of those. Some of the things we've talked about, right? Defensive sectors at the top of the list. Today, utilities, your top-performing sector out of the 11. So all is not perfect. However, the markets are still a hair's breadth away from new all-time highs. Let's see what happened in today's session. Nice rally through the course of the day for the S&P and the NASDAQ. As we get here to our market recap, before we bring up the charts and dig into all the technical evidence, I do want to answer a poll question we had going recently. This is a play on the rock, paper, scissors traditional competition. Which asset class performs the best over the next 3 months? Where do you want your assets to be? In rocks, in the form of gold, the GLD is a good ETF as a proxy there. Paper, which would be paper assets like stocks, so the SPY. Scissors, referring to coupon payments that you'd clip off your bond certificate. Only 14% of you saying the TLT, the place to be. 37% of you saying gold. I would probably say gold, to be honest with you. I disagree with Final Bar Nation saying paper. Stocks, 49%. Stocks are tempting because they've made new highs. I think the key for me is that 3-month threshold. If you look 3 months out, that would take us May into June, July, and August. And if you look back, for the last 5 years, we've usually had a major market top by then. So if gold continues to be strong and stocks are maybe getting to a top here over the summer, maybe gold edges out stocks. I would certainly say either of those over bonds are a pretty decent bet. So I would agree with the general assessment that bonds are not the play. But that sort of asset allocation exercise hopefully helps you think about what that asset allocation could be in your portfolio or in money that you manage, but also force you to look at each of those asset classes using a firmly grounded technical analysis approach. Do your due diligence on each of those from a technical perspective. Where are the opportunities? That's where you should probably have your bets placed. Let's keep going here with our market recap and look at how things played out today. The S&P higher by about 0.25%, so not a raging up day, but certainly not a down day. And really, if you look at what I love about this little 2-day preview chart on our dashboard, it just puts today into context. A lot of times, like if you bring up a brokerage account, you just look at today's trading and it sort of feels like it's happening in a vacuum. But just the simple act of comparing today to yesterday tells you, is there something different? Is it more of the same? Is it something unusual? You can see yesterday's distribution through the course of the day, today's accumulation through the course of the day, but today we really didn't get above yesterday's high. So this was not a big move to new all-time highs kind of move. It was kind of recovering what we lost from yesterday around lunchtime. So the S&P finishing the day just about 53.21, and again, that's 0.25% higher. About the same for the NASDAQ and the Dow. No real differentiation between those. A lot of times we'll have big spread between the Dow and the NASDAQ. Today, kind of everything moving higher. Mid caps and small caps, however, not strengthening at the moment. The S&P 600 small cap index slightly lower today, mid caps as well. The VIX back to an 11 handle, so back below 12. So VIX down in the low teens is a low volatility, low anxiety, low uncertainty kind of environment. The VIX reading right now is telling you long and strong conditions are good. This is sort of a risk on, everything's moving up and no real concerns. The VIX, I think, is so key to watch here because it would be an incredibly unusual event for the market to start selling off without the VIX spiking up quickly. So keep an eye on the VIX, set your alerts on the VIX, watch for those days when the VIX pops higher up above 15 plus. That could be the beginning of that next pullback phase we know is probably going to come here at some point. Interest rates overall moving lower. You can see the 5, 10, and 30-year points on the yield curve coming down a bit. The 10-year points currently around 441. The 5-year point a little bit higher around 444. The long bond around 455. So rates overall are coming off a little bit. The short end of the curve, of course, remaining relatively stable. That's where the Fed is sort of setting that very, very short-term target rate. So we still have the inverted yield curve, but higher for longer is not really what it feels like. This feels like rates are coming down. It's allowing sectors like technology, arguably more like utilities. You could make a yield case that utilities as a very defensive sector, but a higher yielding sector, presents a better and better alternative to rates that are coming down in treasuries. The dollar index, still no real change. And I think, again, when I think about those release valves, things that would start to change, which would tell you that conditions are different. Right now, we're in a low volatility uptrend and we're making new highs for stocks. Risk assets overall are appreciating. What would you see that would tell you something might be different? I would say a big rally in the dollar would very much be a different environment. We've had sort of a sideways choppy dollar. The UUP essentially flat from yesterday's close. The dollar index well below 107, which was that peak from earlier this year. Commodities overall kind of mixed today. The GLD was down about 0.1%, so no real big move to the downside. Silver prices higher. The SLV was up 1%. Oil, natural gas prices all came down a little bit. So energy stocks not having a particularly attractive day here. Cryptocurrencies mixed as well. This is sort of an interesting day, sort of a quieter, lower volume, choppier move type of trading day compared to others that we've seen in recent weeks. Bitcoin back below 70,000, down about 2.5% price today. Ether actually the other way, up about 2%, still around 3,800, we'll call it. Interesting how Bitcoin and Ethereum starting to diverge a little bit. But overall, Bitcoin, that 70,000 level, so important. Big round numbers have often been so meaningful for cryptocurrencies. Look back at the chart of Bitcoin over time, and you can see how all those 10,000 increments tend to be pretty meaningful. So I'm certainly focused on 70,000 to see if Bitcoin can get a foothold above that level. For now, holding in there okay, but as we're going live with the show here, drifting back below 70,000 might be an important level to watch. Looking at the 11 S&P sectors here, again, utilities at the top of the list here. Now, we've got a lot of great questions about utilities. You have to label utilities as a defensive sector, but I would say what you have to remember, and when I talk with my guest today, Julius Kempenaer, we'll get a little bit into sector offense versus defense, I hope. But what you have to remember is that those labels are very much generalizations. The reality is utilities, generally speaking, are a defensive sector because they're very stable businesses. They're low volatility, meaning they don't move a lot. There's not a lot of noise there. They're pretty stable. And then they have a high income component. They tend to pay a high dividend. So those three factors kind of make it, by definition, a defensive sector. Now, it's rallying in a pretty big way. And I forget if I mentioned this on the show or not, but I did read an article, I think last week, talking about how on the earnings calls for utility companies recently, a lot of questions, as a matter of fact, most of the questions looking at the major utility companies were about data centers and about the electricity and energy needs of processing for cryptocurrency, for crypto mining, for AI, and all of the processing power that is required there. So, and the last earnings cycle, it was like less than 10% of the questions were related to that. So it certainly is seen as sort of a growth space based on the power needs of those themes that I mentioned. So absolutely true. However, compared to other sectors, utilities are still, by their structure and by their definition, a very defensive type of owning equities. Equities in general are more of an offensive play compared to other asset classes, but utilities are certainly more defensive. And as much as you tell me why this might be happening, I can't feel great about utilities leading the way higher in any environment. Maybe I'll get used to that at some point, but not today. So the XLU up about 0.9%. That's your leader today. The XLY, consumer discretionary, up 0.7%. Tesla had a pretty decent day, up 3 to 5%. I didn't catch it at the end of the day at the close, but nice updates helping propel the XLY a little bit higher. Financials, number 3, up 0.6%. On the downside, 4 of the 11 S&P sectors finished in the red. Energy down 0.5%. Industrials, 1/3%. Communication services down 0.1%. Looking at those mega cap leadership names down here, you can see Tesla. Boy, Tesla really rallied into the close. Nice up move, finished near the highs of the day around 187. That's up almost 7% from yesterday's close. Netflix making a new 52-week high, closing above 640, actually above 650, up 1.5%. On the downside, only 2 of these mega cap leadership names down. Meta and Amazon both finished below Monday's close. Let's go to a daily chart of the S&P 500, see what sort of damage was done. And overall, again, we continue to make headway above 5,300. We're looking at the chart here. We're looking at the last year plus, year and a half almost. Really just see how this current move fits into the longer trajectory. So my market trend model is bullish on all time frames, short term, medium term, long term. And as I look at this chart, just a very subjective view of the action, that makes 100% sense. I mean, it's hard to deny the fact that the market is going up. It's hard to deny the fact that the momentum overall is improving over the last 3 or 4 weeks. We're back above moving average support. The moving averages are sloping upwards. We're making new all-time highs, and today represents a new all-time closing high at 53.21 plus. So overall, the conditions are strong. I would say any skepticism I have for this trend are just the conditions underneath, thinking about leadership themes, thinking about price momentum and other things that could help us qualify whether we should believe in the sustainability of this move. But from a pure price perspective, prices are going up. And when my market trend model is completely bullish, which it is, it tells me to be confident, thinking about opportunities on the long side, looking for good charts at good actionable buy points, and not being afraid to take on additional risk. And investors taking on risk in the last month have been handsomely rewarded from the S&P, the NASDAQ, and a lot of other things making new swing highs. Let's look at some of the other charts I think top of mind here to round out our market recap. The MAGS, which is a Roundhill Big Tech ETF, good ETF, just tracking, I think, as a proxy for the Magnificent Seven stocks. Now, the QQQ does not look very much different from this. Arguably, things like the XLK and the XLC are very similar to what you're seeing here. But, for me, just looking at this ETF, because it is as pure of a bet as you can make on the Magnificent Seven, those mega cap leadership names, they are making new all-time highs since the initial ETF release in 2023. This is the highest level it's been, just above $41. And I think this is making headway above previous all-time highs from early April. So this chart making higher highs and higher lows, the trend is positive. The RSI is pushing above 60. That's bullish. The relative strength is strong, which tells you, again, even with a lot of other names showing some attractive moves, the Magnificent Seven, this group of mega cap leadership names, still doing quite well. And again, the price continuing to move to the upside. Semiconductors, of course, looking pretty strong here as well. The SMH, I think, is at a key point. While you have the S&P, you have the Dow, you have the NASDAQ, at or near new highs, really pushing above those highs from April and maybe March. Semiconductors notably have not done so quite yet. Here in March, you had that bearish engulfing pattern, just one of the most classic examples of that pattern and why you should pay attention to candle patterns. Even if you're a medium-term or long-term investor, recognizing as we make new highs that you have this big distribution day, an outside day. If you're a fan of bar charts like this, if you're a candle chart fan, this is going to look like a classic bearish engulfing pattern. Tells you short-term weakness, and that absolutely played out. Now semiconductors using the SMH made a low around 200, then pushed back above the 50-day moving average after testing it there in late April. We're now threatening new all-time highs. ETFs like the SMH make new all-time highs following the major averages. It's hard to think of that as anything but pretty bullish. And for now, we keep an eye to see if that would happen. Now, that pattern, that issue, I think is reflected with NVIDIA and a lot of the individual names, particularly the larger names as well. NVIDIA is one of those Magnificent Seven names that has not yet made a new all-time high. The RSI is sort of languishing around 60. We're really, really close to breaking above those resistance levels in March, but we haven't quite done it yet. I think the bull case for stocks means NVIDIA and other leading names like that have to keep going up and pushing to the upside. Only if those names move higher can our growth-oriented and mega-cap dominated benchmarks really make significant gains beyond what they've done so far. Let's finish off looking at some individual stocks. I want to bring in a little more time. This is First Solar. FSLR having a nice day, up another 8% today. But again, when you have a stock making a big move like this, I think it's important to remember the phase that we're in, right? One day is just one day. A trend is not made on one day's price bar. It's made after a trend, the evolution of days like today and how they've evolved over time. Look at what First Solar has done over the last 12 months. In May of last year, we're at $230 a share, still a little bit above current levels, just above $212 or so. We then sort of made another test of that resistance here, and all of a sudden you have this well-established level of resistance, right around 220, 225, and that held for about 6 months here in mid-2023. Then things really started to deteriorate, and by October, November of 2023, we're below 2 downward sloping moving averages, and this stock looked really negative. I remember at this point, it was really a question of where would we find any sort of support. Look at how we saw things start to stabilize, and that 130 to 140 level became support a number of times. We tested it again in December, in January, in February. finally we started to make some higher lows, and we went from what's called in my terminology, a consolidation phase, which is a sideways move, to more of an accumulation phase, or once again making higher highs and higher lows. From February through May, we are now making higher highs and higher lows. That's very different. We're now above upward sloping moving averages instead of below both of those. The momentum has gone from a clear bearish range remaining below 60 to a clear bullish range remaining above 50 since late March. So overall, First Solar, some of the other renewable energy names really starting to improve. Now we have significant overhead resistance. I think this chart looks really compelling over 230 because that would get us above that May 2023 high, be a new 52-week high for the stock. But overall, the trend is certainly strong leading up to those previous highs. We had a bit of a bearish divergence, which I would argue has now been negated because we're making new highs on stronger momentum. Look at the relative strength making a new high as well. Nice development there. I want to look at Hewlett-Packard underscore HPQ, and the reason why we're putting an underscore, anytime you have kind of a higher yielding name, the forward dividend yield on Hewlett-Packard is just over 3%. Anytime you're looking at that and you're trying to think about price levels, I like to put an underscore on there. You can also, by the way, below the chart, say adjust for dividends. Just make sure you deselect that. And on ACP, you have a similar setting in your settings for price to adjust or not adjust for dividends. And if you look at the unadjusted data, you can see $31 a share was a big time resistance level for Hewlett-Packard. After rallying off of a September low last year, we hit resistance around $31 in December. We retested that in January, retested that same level in March. And so the more times you test a level, in my experience and how I was taught, the more times you test a level, the more and more it validates the importance of that resistance, which means you expect that to hold. And if and when it stops holding, if we finally break above there, that tells you something's different, right? We've been unable to get above the ceiling of $31 for months and months now. Then we finally are able to. Now there's a little more resistance ahead in the $33 to $34 level. Now we're testing the summer 2023 highs. But I like that breakout of above 3,100. That's after bouncing off a clear support level around $28 a share from February, April, and May as well. So nice setup for Hewlett-Packard. Look to see if it can get above that resistance from summer of last year. UNP is a great example of, probably what I would not call an ideal head and shoulders top, but I'm sure some people will notice this. A head and shoulders topping pattern is when you have a top, a high, surrounded by two lower highs. Ideally, it's a fairly symmetric sort of illustration where the head is in the middle, but then the left and the right shoulder are similar. If one looks very different than the other, right? If one is simple and the other is complex, right? It's a little less ideal, but that isn't too bad. What does make me a little bit concerned about this being a perfect example is the neckline. Ideally, in a head and shoulders top, the neckline actually slopes higher, and a break of the neckline is what validates it. Because you had this weird low down here in April, the neckline actually has to have this slope, which means you have to get all the way below 225 to kind of complete that breakdown. I would argue, given the fact that the 200-day moving average is right around 230, the fact that the swing low in April is right around 230, I'd probably consider a break below 230 as being a pretty good signal that this is really in distribution, particularly after that lower high. But textbook version, if you're studying for the CMT, you have to be skeptical. You have to really wait for a break below the neckline, which needs to get all the way down to around 225. Notice how that last rally, that right shoulder, the RSI stalled out at 60. It's almost a perfect example of the what we call the range rules for RSI. Last one, I'll bring up AutoZone AZO, and what I like about this one is it's actually trading down to a pretty clear support level, right? So we're actually trading lower. If we look at just the recent history, maybe we'll take a candle chart here. Yeah, if you look here, right, look at the support around mid-April, late April, right around that 2,900 level. You can see that we bounced off of this a number of times and then finally broke below it. Look at these long lower shadows or long lower stems here in mid-April and in late April. That really represents that buyers are coming in and buying on weakness around 2,900. We bounced off of there again, but then today actually pushing lower, which means I then think you need to zoom out a little bit and look for additional support levels. What's interesting is we're actually trading down to what you might consider a pivot point, kind of in this 2650 to 2750 range. We have the 200-day moving average. We have previous resistance, which has become support. We're kind of trading down to those levels. So overall, I would say this is a chart in a distribution phase. Certainly seems like resistance here around 3,000 at the 50-day moving average. A move back above there looks pretty compelling, but until proven otherwise, that certainly appears like a downtrend in a pretty decent pace. That's our market recap here, talking about some of the major moves in our averages at or near all-time highs, some of the stocks on the move and groups and ETFs underneath the hood there. We have a great guest today, Julius de Kempenaer. Before we bring Julius on, just one quick announcement, and that's to send your questions our way. We're going to be doing a mailbag show later this week, and we'd love to answer one of your questions as part of that mailbag episode. You can email us your questions at thefinalbar@stockcharts.com. Here on YouTube, of course, just drop a comment below the video that you're watching. You can also tag us on X at FinalBarSCTV is our tag there. We'll look forward to hearing from you. Can't wait to get your questions, and we'll hope to answer one of yours in our next mailbag episode. I want to welcome on today's guest, Julius de Kempenaer. Julius is the founder of RRG Research, part of the team here at Stockcharts.com, coming to us from the Netherlands. Julius, good evening. Thanks for coming on today. How are you?
Good evening, Dave. I'm well. Yeah, thanks for having me back.
No, it's good to chat with you as always. I'd love to just debrief to start with on the overall market. You wrote a really good article on Stockcharts.com here in the last couple of days talking about the market conditions. We're at or near new all-time highs for all the major benchmarks. When you're observing this run here in May, should we be optimistic or not as we're making these new all-time highs? Where do you come out?
Yeah, well, I'm at least cautious. I mean, I'd love to, don't get me wrong, I'd love to see this break hold up and carry us higher, because in general, it's better for everybody. But when I try to take away my subjective I wish hat and put on my what's really happening under the hood and just go over a few of the metrics and the characteristics that we have to analyze the markets, I see a few things that make me go I'm not really sure whether this is what we really want to see.
Yeah. Your first chart in the article, which I'm showing on the screen, really addresses the volume, I guess, discrepancy between the first half of April, market moving lower, and then the second half of April, mid-May, market moving higher. What is the volume condition? What does that tell you about, I guess, the sustainability of this move here?
Yeah, so, I mean, when I started analyzing charts and obviously the volume that came with it, the market structure was completely different. There was only one exchange, all the volume went through that exchange, and that was it. So volume was a really valuable additional indicator, was a really valuable metric. In general, I believe that the value of volume as a metric has diminished with all the dark pools and different ETNs and all that kind of stuff. I mean, institutional investors can trade millions of shares and we won't even see it because it goes off market. So in general, I don't pay as much attention to volume as I used to. But with the index, I took the approach let's use it as a proxy. I mean, it's probably kind of in the direction where the market is. And when I look at the volume that's traded on SPY, and by the way, as you know, the technical rule is that volume needs to increase in the direction of the trend. That's the confirmation of volume. So when you have an uptrend, you want to see volume rising in the up lag, and when it goes through a correction, you want to see a little dip in the volume, and then when it goes up, you want to see rising volume again. And in general, that's what happened in the rally. And the chart that you got up on the screen, in that green area, you see that volume, it wasn't much, but if you look at the moving average, just to ease out the little spikes, you can see that the moving average went up. So the volume went up when the market went down. And then you see the up move, and then you see the volume moving lower. You see the volume diminishing. And that's a volume characteristic that belongs to a downtrend. So, and then even, again, if you break out, you really like a breakout when you've got exploding volumes. That's what you really want to see on a solid breakout. Not happening. So from this chart alone, I see a volume pattern. Let me be careful here. That it's not like it does belong to a downtrend, but it definitely doesn't belong to an uptrend. and we see a breakout that is not confirmed by a breakout in volume. So there's two issues that make me raise my eyebrows. And then I started to dig a little bit deeper to see what else is going on.
Yeah, I think that's well said, Julius. And you and I think, both describe it as confirmation, right? Is volume confirming what you're seeing with the trend? And certainly hasn't been. And certainly this breakout has not been with the stronger volume you might want to see if you're really optimistic. You made another point recently, just talking about the momentum characteristics and just thinking about how this market is moving in terms of momentum, using indicators like RSI, MACD, things like that. When you think about price momentum, does that give you more or less confidence in what we're seeing here?
Well, I mean, this is a daily chart, but the ones that I wanted to look at were the weeklies. If you look at the weekly, especially, this one, look at the RSI, and let's start with the RSI. So you can see that in the entire run up since it was October last year, you can see how that RSI is basically confirming that trend. And then in the dip, RSI dipped pretty strongly back to almost 60 something level. And now we're going up, but we're nowhere near the level of the previous peak, while, as you all know, the price is breaking above the peak. So this is, in my view, this is not a negative divergence yet, because the RSI has not made a new peak yet. So, if we carry this on, and that leg of the RSI goes above the previous high, then it's all good. But it's going to be difficult, because the RSI went to pretty high levels, and it's doubtful whether it will really do that. And the same thing goes with the MACD. These are two super simple, basic decades of years around, and they're not confirming the break in the S&P. And that's the second thing, like, we really should have that confirmation in the MACD, with the MACD line above its trigger line. We should see the RSI above its previous peak. That would give me the confidence to say, like, hey, yeah, we're ready to rock and roll. But not happening.
We're not getting that confirmation anywhere. I think we've gone long enough without showing an RRG, Julius. So let's go there next. Talk to me a little bit. So we have less volume than maybe ideal, less momentum that you probably want to see. What about the leadership things? We've been talking a lot about some of the defensive sectors like utilities that have done quite well. When you're looking at the RRG rotation, are you seeing that in your work as well?
Yeah, I've been talking about this for quite a while already. I mean, the defensive sectors are on a roll. I mean, utilities, very long green tail, just pushed into the leading quadrant. Consumer staples, the blue one, inside improving, heading towards the leading quadrant. And we've got traditionally healthcare seen as a defensive sector that's inside lagging, but it just started to curl back up. We can have a discussion whether healthcare is still a very defensive sector, because there are some growth stocks in there, but in general, it's traditionally a defensive sector. And then we've got energy, which is deep inside leading. It's starting to roll over. And I've recently also updated some of my stuff on beta values. And energy is a really low beta value. Low beta is defense, high beta is offense. So we've got a lot of the low beta stuff moving to the right, defense moving to the right, which is something that, again, I don't expect to see this type of rotation in a full-fledged bull market. And then when you bring in, the other side of the equation, which are the offensive sectors, then technology, XLK is right now, S&P calls it an economically sensitive sector. So they added a third group. They got offensive, defensive, and economically sensitive. And technology is definitely in that group, in that economically sensitive group, because it was kind of a defensive group when, during the pandemic, technology, when everybody wanted tech, because that was your best bet, that was your safe haven. I think that has come back a little bit right now, so it's debatable where it is. But it's definitely not a super defensive group. Let's put it like that. So there's definitely some growth characteristics in there, and it's in lagging, picking up right now. If you look at probably the most offensive group, that's consumer discretionary. And If you look at that tail, that's pushing into the lagging quadrant, pushing further into it. And if you switch this one to a daily chart, then you will see that the tail for consumer discretionary has pushed into the lagging quadrant there quite strongly. And now this was a good day, but so all in all, defense is rotating against what you would expect, and so is offense. So there is a mismatch in the rotation between what we see in the S&P chart and what we see on the actual rotation. Because let's face it, utilities right now, I mean, again, today I'm watching at the sector summary on the homepage here. Utilities strongest sector right now. Second one is consumer discretionary, but the fact that utilities is number one and consumer staples is number four and healthcare is number five, it is weird. We got utilities leading the market. The S&P is going up. It's a strong, 0.25%, not that strong, but utilities are beating the S&P 500. That is something that usually happens when the market's under pressure.
So given this, we only have about a minute left, Julius, but given these conditions, lack of momentum, lack of volume, a lot of defensive leadership, how do you position yourself in this sort of things? And I guess another way, where do you see opportunities given where we're at in the cycle? Do you lean into some of those defensive areas of the market? Is technology, which may be good offense and defense, is that a place to be? Where would you be looking your opportunistically?
Well, so very good point. In technology, I think it's pretty clearly that you want to be in the large caps.
Yeah.
You want to be in large caps. So that, again, if you want to bring in another metric, large cap versus small cap or large cap versus mid cap, in those offensive groups, it's the large caps that outperform. When large caps are outperforming, that's a kind of a, market under pressure. In a super bull market, you've got small and mid caps rallying, and then you've got everybody getting out of the large because everybody knows the large cap. Yeah, they'll do it. You'll pick up some, very nice growth stock that can be a 10-bagger. And if that doesn't happen, you go for NVIDIA, you go for Microsoft, you go for Google, you go for, whatever. So, all in all, but I mean, so right now I am cautious. I am very careful. I'm not going to go like, bet the farm literally on a rally in the S&P. The way I look at it is that this can resolve two ways. Either the S&P will come back and get in line with all the red flags that we're seeing that we just discussed, or the sector rotation, the volume, the growth stuff will follow the S&P all along. So I don't know the answer to that. Honestly, I don't know. It's just like at some stage, it has to come back together. At some stage, the S&P rally needs to be backed up by consumer discretionary, by industrials, by materials, by technology, etc., by small caps, by mid caps. The volume needs to pick up. We need to see a breakout in volume. We want to see those RSI and MACDs get back in line. And if that not happens, then the S&P's got to come down to get back. It's either or. At some stage, they've got to come back together.
Yeah, there's a disagreement right now. We'll certainly want to follow the charts together, see how this resolves, Julius. But listen, thanks for a great peek underneath the hood of the market. That was brilliant, highlighting some of those key, I guess, disagreements right now. And thanks for jumping on the show. We'll talk to you again soon, all right?
Absolutely, my friend. Talk to you soon. Bye-bye.
That's Julius de Kempenaer. Julius, a senior technical analyst here at Stockcharts, founder of RRG Research. Again, I've known Julius for many years, and that little 10-minute summary is just a great representation of how using the RRG, using tools to understand rotation. We just looked at sectors. You can look at equal-weighted sectors. We can look at asset allocation. We can look at different themes, thematic moves, and how they're related based on their rotation around a benchmark that is of interest to you. Great take there, as always, by Julius de Kempenaer, founder of RRG Research. Folks, that's our show today for a Tuesday afternoon. Thanks for watching us every weekday after the close. Until next time, be well, stay safe, have a good night.